Hello, everyone. Today we have the privilege to have Mr. Sunil Mehta participate in a conversation with us. Mr. Mehta currently serves as the non-executive chairman of Yes Bank and was previously the chief executive officer and country head of AIG in India. He is also part of our advisory board and our investment committee. Thank you, Sunil, for taking the time to be with us, and it's great to chat with you today.
Thank you. Hi, Sunil. Welcome.
So what we thought we'd do, Sunil, today is have a debate about the current state of the economy. Obviously, the last couple of years have been very difficult, and there are global geopolitical events that will have an impact on India and the broader global environment. So we thought we'll have a discussion around some of these points and the implications for India and the implications for investors who are looking to deploy more capital in India. Why don't I kick off with the first discussion point? The economic challenges posed by COVID were significant, and the country is still recovering, particularly SME businesses in India. We wanted to discuss how the government's policies and reforms over the last 12 to 24 months have helped on this path to economic recovery, and particularly to what extent have these reforms benefited MSMEs in India, given they've been the most hit by COVID.
Thank you, Sid. I think you hit the right point in terms of the black swan events that we are witnessing or we have witnessed over the last 24 months. I actually characterize this from a risk management perspective that financial institutions are truly prepared and they have the ability to decipher risks, which are what I call the known unknowns. But in this case, we've been sort of dealing with the risks which are called unknown unknowns. And I think that's really taken everybody into a point of relooking at how they respond to what we've witnessed over the last 24 months. And I looking back at this, I must admit that both the government and the Reserve Bank have actually responded exceptionally well in these circumstances that we've sort of gone through. Since I was heading a bank which was actually thrown into the reconstruction exactly 2 years ago in March 2020, I have sort of seen this from very close quarters as to how a bank which was coming out of or should have come out of this difficult situation, how we were able to also work along with the Reserve Bank and the government in sort of swimming through this turbulent waters. So firstly, I would sort of say that the Reserve Bank, and I think the Reserve Bank responded admirably, both from providing systemic liquidity into the system and also at the same time dealing with the aspect amongst the financial institutions of risk aversion, which was quite natural for banks and NBFCs to deal with a complex situation and be probably risk averse to sectors that got hit the most. From a corporate world, it was the entire travel industry, the real estate, the leisure industry, the media and entertainment piece. So there were large segments of industry which sort of almost came to a grinding halt. And in the large corporate world, you had the entire feeder industry, which is the SMEs and the MSMEs, that had to also be dealt with. Now, they don't carry elongated working capital, so which means the bank had to respond with the support of the Reserve Bank in dealing with both the risks and the liquidity piece. Hence, they came up with both from risk mitigants. I don't want to get into the nitty-gritty and the specifics of it for your international investors' perspective, but both from risk mitigation and also from a liquidity support. And I think that intervention during this period really helped the financial institutions to tide over this. There is no doubt that several MSMEs got into a difficult position, but I'm quite sure that as the economy starts picking up, that they will also be able to kind of come out of this. And they will probably take a little bit longer, but I have no doubt that this would sort of, with the projected economic growth and GDP growth, they'll be out of this situation. Now, this was the COVID impact. Now we've got the new developments over the last 4 odd weeks on the Ukraine issue and the geopolitical issue. This again gets characterized into the unknown unknowns. Of course, there were tensions that were building, but the fact that there would have been such a serious issue on the physical front that has happened, and the way it has disrupted global supply chains I don't think anybody was prepared for this as well. So I think again from this, what we are seeing today, government is attempting to navigate this through. It's quite obvious that the commodity prices and oil in particular is going to have an impact on the economy. There will be some impact. You can't say that will not be impacted as we sort of move forward, because the challenge here is, again, like in the case of COVID, no one knows as to how long this will take. If things start easing off, I would imagine that it'll be much better. But if it gets prolonged, I would imagine that most governments and institutions will have to find innovative ways of dealing with the supply-demand mismatches, as well as the aspects relating to sanctions and the impact on foreign currency and issues relating to payment systems globally in squaring off where you buy your commodities and crude from. So I think this is work in progress. A lot will need to be done for us to be fleet-footed to be able to deal with it. I think so far as what the navigation that is being, what we are witnessing, I think it's being well navigated at the moment.
Sorry, Sunil, just a quick follow-up question on that. I think you saw different reactions in the developed world versus in India. I think on the Indian side, like in the developed world, there was obviously a lot of supply side stimulus that came in, but nothing really on the demand side. And I think if you see some of the developed countries, they were able to support some of the small businesses either by covering some of the employee wages, giving direct SOPs to some of the businesses to keep them afloat during lockdowns. We didn't see enough of that in India. What's your view on that? And do you think that the government should have done something more on that front? Or do you think how they've responded has been adequate for the businesses in this country?
Sumit, I think there is really, the way I see it, and having witnessed this over the last 40 odd years in my own career, whenever we face a situation like this, there is no one solution that fits all. And our economic structure, our fiscal situation, our size of the economy versus some of the other developed markets is quite different. And our vulnerability at the bottom of the pyramid is also very different. How much flexibility did we have to be able to pump in the kind of liquidity that we saw in the developed markets at one go was certainly, I didn't see that we had that ability to do so. It would have sort of really put ourselves into a very complex fiscal situation. And I said, thank God for that, because nobody anticipated that soon after the COVID, you would have another problem that is emerging now. So I think the reaction of a measured reaction that was sort of, in some cases, people were critical of it, but in hindsight, I think that was the right approach. And that suited what we could afford to do at that point of time. Yes, There was a lot of challenges that the SMEs and the MSMEs, but I think the banking system, to whatever extent it could, with the support of the Reserve Bank and the government, did come out to do what they could and ease the pain to some extent. And we were all very hopeful that, as we saw in the last quarter of the calendar year 21 and in the first quarter of the first 2 months of 22, that we were almost sort of projecting a fairly robust economic growth from there, which would have sort of brought in all the MSMEs, or a significant number of the MSMEs, back into business. It's a complex situation. There's no perfect solution for everything. So I think step by step we are learning, and I would still say that whatever was done from our context, from the Indian context, was probably the right approach to follow.
Yeah, I think businesses have, in general, been quite resilient through this pandemic period. I think the first wave was the worst one, given the significant lockdowns we experienced across the country. But then wave two was less of an issue for businesses beyond once everything opened up, which was a shorter lockdown. And then I think we were largely unaffected during the Omicron wave a few months ago, at least when it came to business operations and consumer demand and consumer spending. So businesses in general have recovered quite fast and have found ways to survive and extend their runways, and that goes with our portfolio as well. So we hope the worst is over with COVID at least, and I guess we will see how we react to the geopolitical issues today in India. But we feel quite bullish about the mid to long-term prospects in India. And I think the GDP growth forecasts over the next couple of years are going to be relatively the best in the world, 7-8% year on year. So, I think in that sense, we are in a very stable and favorable position relative to the rest of the world.
If I may add, Sid, actually, there are many lessons that we have learned from this, and we should be learning. I think the important thing is that if you look at business resilience, that is sort of needs to be embedded in our kind of a ecosystem that we live in, to make sure that small, medium, and the mid-sized businesses don't keep getting, on a recurring basis, feel the pressure and the onslaught of these kind of issues that now, when the economic cycle is getting shorter and these kind of events coming in with a much faster speed, we have to see how to construct this much better so that they are able to withstand these shocks. And the kind of risks assessments that need to be done, even for them, in terms of the kind of businesses that they are pursuing and how they need to kind of get recapitalized or get long-term working capital to be able to sustain these cycles. This is something that we all have to wake up and make sure that every business is taking a deeper dive. Number two, historically, through perhaps, I would say, what we'd seen many, many years earlier, that we were suffering because of the over leverage in the system. And as a result, a lot of the corporate sector and the mid-size and the small size suffered on account of the stress asset situation, the whole credit piece. And that is another area that we sort of have to come to grips with, as to how do we kind of make sure that there is adequate capital that is available to the business, so that the whatever leveraging they need to do, they should stay at a reasonable level. But there will be occasions where they'll have to rely on some extreme debt and support from the financial system. Now, all these aspects, the construct of these businesses, we shouldn't sort of lose sight of that we have to go through this process. The third piece is that the regulatory architecture to deal with this as well, so that when we see the situations deteriorating, there are enough early warning systems and regulatory interventions that come in time to kind of deal with these in a much more proactive basis. And I think as the economy becomes bigger, we have to worry about too big to fail syndrome that we've seen in the more developed economies and the larger economies itself. And some of the systemic risks that keep building in the system and never get highlighted till there's blood on the streets. So all of these are aspects that what we've witnessed over the last 24 months, as the economy starts picking up, we should not lose sight that we need to deal with this with all degree of honesty so that these don't get repeated. And I think that's what I want to say, that there is a much larger responsibility on the businesses, on the government, and the regulatory architecture or the infrastructure that we have, that we are better prepared going forward.
Yeah, well put, Sunil. Talking about the banking sector, you mentioned what's happened over the last few years with the restructuring and the bankruptcy code, et cetera, being established. We saw a massive cleanup, at least on the public and private sector banking side. Many of the banks that had poor quality assets cleaned up their books and took the provisions and the write-offs. And then obviously COVID hit as well, which has had an impact on lenders and their credit performance. We saw a moratorium in the first wave, at least 6 months, that at least most SME businesses and consumers took to kind of delay their loan payments, which did have an impact on the lender's balance sheet. So in your view, as you look at where we are in the credit cycle today, do you think the NPAs have peaked? Do you see there is still pain coming in the near future? And if we look at the different segments of the lending market, where do you think the most pain lies? Is it in the SME space? Is it in the consumer space? We've seen personal loans really drive growth of the lending industry in India with these checkout financing loans and the buy now, pay later loans and the sort of small ticket financing that consumers have taken. So that whole segment has grown significantly. And these are short-term unsecured loans. So in your view, which segment of the lending market is, could see the most pain, and where are we sort of in that credit cycle?
I could spend an hour on this one, but I'll try and be brief. I would say we had seen this building of the NPAs from early 2000 until 2014, 15. There was a global liquidity. There was also post the global financial crisis, there was more. We also benefited from that global liquidity that was there. And the Indian banking system also, we found that there was a lot of liquidity that was in the system. And there was also strong growth winds that were there. So it was propelling a wonderful growth path with a lot of liquidity and strong growth, infrastructure financing. And there were so many elements of that, real estate, and every sector was really going as gangbusters. In late 2007, early 2008, when I was part of AIG, I remember having a meeting with all our businesses and asking everybody to sort of think through what could actually spoil this party. Well, the sort of, and I think everyone had to scratch their heads. This was early 2008 to figure out what could spoil the party, and they sort of came up with that perhaps some unknown geopolitical issue. But then 6-8 months later, you know what happened. So this element of euphoria that was built, which led to perhaps us not seeing the risks as smartly as we should have, led to this huge NPA accumulation by 2014, 15, 16. And then, of course, there was a problem that can we keep kicking the can down the road, or should we really take the whole provisioning that was required to be done, looking at the situation that we were facing in the public sector banks. Being on the board of State Bank of India and then subsequently the chairman of Punjab National Bank, I had the also, I think, the ability to see on a macroeconomic basis and, of course, the industry, how it was getting impacted. I think the important thing that happened was the fact that everybody decided, let's start recognizing and providing for it, which meant recapitalization of the banks. It had to be done in a systematic manner. It couldn't be done overnight. So there was a calibration in this entire process. And the fact that from 2016 to 2020, this whole cleanup started, and the whole on a portfolio basis and then on an individual credit basis was a very good exercise. In 2018, we had done that stress asset resolution report, that Sashakt committee. And I think that was also a great learning in terms of how to deal with this issue of the resolution of stress assets, which now is under implementation through the intercreditor agreement and now the national ARC and everything else that is sort of coming up. So I think in many different elements of the banking and the financial system and the regulatory system and the government support being provided on the national ARC through the guarantee, this cleanup exercise is underway of the historic bad assets. What is absolutely critical, as I keep repeating, that as and when the economy starts moving back again at a very good clip, we should be so vigilant and have, say, very strong risk management practices that these do not reoccur. Now, whatever we learn from the past, I think will probably be in good stead, that we'll sort of make sure we don't make those mistakes in the way they had been done in the past. However, what we have to be cognizant about is that there are new risks emerging, because as technology gets embedded into the system and we are going to be much more dependent on technology, the whole aspect of cyber piece in this entire ecosystem of financial markets is an element that we have got to be truly watchful for, that will this create some future upheavals in our system. So that is why the whole aspect of the cyber risks that is there is now being seen with a microscope in terms of how well prepared we are. And to your point about looking at the personal loans and the individual loans and the small ticket loans and the building up on that side, you can only deal with it if you have very good technology and sort of are dependent on analytics and artificial intelligence, sort of creating, as I said, early warning signals on the entire portfolio. So from that point of view, how you build the risk protocols that you do not have, because the entire ecosystem is now connected on your core banking system and the technological connectivity that is there, that you are so watchful that these do not kind of come into your financial markets and disrupt them. So from a pure credit risk, now you're looking at market risks, which are also now becoming a big issue, and the cyber risks. And so there are different elements of risks that will actually re-emerge, and we've got to be prepared for those. So it's not pure credit issue that I'm concerned about. I think there will be other aspects of risks that we'll need to be prepared for.
Yeah, touching on your point around the importance of technology, clearly there has been a massive push towards digitization and the adoption of digital banking and digital financial services in India. We have the incumbent banks that are trying to adopt and trying to partner with fintechs. And to some extent, there is a healthy competition between fintechs who are obviously digital first and the old banking sector, which is the more traditional banking model. So would be interesting to get your views on the opportunities for these banks to adopt technology and to adopt it in a much faster way, and how you see competition between the banks and the new age fintech players. Do you see opportunities to collaborate? Do you see sort of one model winning over the other? There are also potential risks to such a rapid adoption and rapid change, because these are, at least in the banks, these are legacy systems that have to go through a massive overhaul to become more nimble and to become more digitally savvy. So would love to get your views on how you see technology as a disruptor and how you see banks adopting technology.
Well, Sid, I think this is what the entire financial markets and I would say not just financial markets, but the entire business system needs to now be fully prepared that new technologies will, or the entire digitization process is going to be becoming part of an ecosystem. And I will deal with it in 2 or 3 different facets. One, of course, is the absorption of this. You spoke about collaboration. And you also spoke about competition or threats from the fintechs and the insurtechs. I look at it that was perhaps the way it was in the past, but going forward from here, it is not a threat, but it is the only way of survival of the entire system is collaboration and absorption of technology into the entire system. Because you can't have pure fintech monoline players and banks which are bereft of the technology that is required for them to serve their customers and have the entire analytics and artificial intelligence to deal with some of the aspects of financial markets. So this is now truly a partnership, which is how fast the banks and insurance companies can absorb technology into their system and become part of this. And the fintechs and insurtechs will play an exceptionally important role in creating this collaboration and partnership and the complete absorption into the system itself, so it becomes seamless. The second facet of this is in our ecosystem, because if you look at the way technology has played a role in the financial markets in the more developed markets, and there are examples of how fast they have moved in and how they've sort of displaced some of the traditional players, like what you had Jamie Dimon of JP Morgan saying in terms of where he sees his bank. I look at it that from an Indian perspective, it's a multifaceted approach that because if you look at the entire market that we have, it's a layered market. There's no one technology solution that you can offer to the entire, let's say, a State Bank of India. Assume that they have 500 million customers. I'm just throwing, I don't know the exact number now, but whatever the number is. Or even an LIC today, 500 million policy holders or whatever. Now, if you're sort of dealing with that mass, you have to have a solution, a technological solution, or a digital solution, or a different solution that sort of caters to the different strata of your customer base and how you're going to connect with that. I think we'll have to evolve this over a period of time. And the smart way is that do not over-invest into the same platform, which will perhaps not be fully used at different customer stratification that is there. So we have got to think through that very carefully. Now, the entire system of where we are looking at the digital piece into the financial markets, it has evolved in such a robust manner because in the mid 80s when I was part of Citibank, and then we had such a competitive advantage of having global technology available with us, so that we could have better cash management system and trade management systems. That entire competitive edge, what was available to the foreign banks at that time, is now sort of being made available because these are off-the-shelf technology platforms that are available to the entire system itself. So if I, as a bank or a financial system, have that, I have to integrate it to my clients as well. So my corporate clients. So this integration process. So this is now a continuous game that everybody has to be sort of working, because if you don't have that integrated into your client, again, you'll have a disparate handoff that sort of takes place. So it is in the entire financial market's interest to work seamlessly with the entire corporate sector. And of course, then you keep going down into the small and mid-sized enterprises to complete this integration process, to be a very efficient supplier of financial products and services. And at the same time, I keep repeating, we have a new element of the whole data privacy on this, that how do you now deal with, now that you have all of this is integrated, you have huge amounts of data, but you still have to dealing with that in a manner that will very soon be tightly regulated as well, depending on how globally governments come up with their own regulatory framework on aspects relating to data. This leads to the second thing, that if you have now a globally integrated platforms, how do governments work together to create a regulatory architecture which is also seamless? So we talk about the cryptocurrencies. Cryptocurrencies, I may want to deal with it in India, whether we ban it or we tax it or we have our own digital currency, a central bank digital currency, but this is globally integrated. So, but if I have a regulatory architecture which is completely separate from what it is globally, I will not be able to enmesh this. So when the Prime Minister made that speech to the World Economic Forum about that we need to work together amongst major nations, particularly amongst the G20, to find solution on dealing with the cryptocurrencies, the growth of cryptocurrencies, we have to start thinking, what platform do we have now to be able to deal with this and have a kind of a regulatory construct that is acceptable to all the market, acceptable to governments and all the decentralized market players in this. So there's so much to think about as to how this evolves. And from a formulation point of view, from a business point of view, from a regulatory perspective, and of course, the opportunities that it provides to entrepreneurs and private equity capital that goes into dealing with these new opportunities that are emerging.
Right.
Very true, Sunil.
Thanks, Sunil. So just shifting gears a little bit, you touched upon this a little bit earlier. that we've just come out of this good sort of Q4, moved into a first 2 months of the year being very positive from an economic standpoint and sort of leading indicators. And then obviously we have the situation with the geopolitical crisis. Apart from that, you have the rising of interest rates in the West, tapering of the liquidity that was built into the system. Obviously now rising commodity prices, largely for India being oil, but also with some of the lockdowns in China, logistics and other commodities will also be impacted. Russia is also a big player in the commodity market. So there are going to be some headwinds that we are facing and will continue to face at least in the short term, potentially the medium term. We've seen the FIIs withdraw a significant amount of capital from the Indian public markets in the recent past. Obviously, I think the private markets remain extremely strong, with a lot of investment still being focused on India. What is your sort of medium to longer term view on the impact of this on the Indian economy? Obviously, none of us has a crystal ball, but your own personal view would be extremely enlightening.
Sumit, I have been part of this Indian economy for the last 40 years, and I think I've seen the 92-93 crisis, when we had this whole issue of our reserves sort of being available only for 14 days of imports that was there. And we were down to that small wafer thin 2 weeks ability to import crude. And then, of course, subsequent domestic and global issues that have hit us. I think one important learning over these years has been that many of these domestic or global issues have hit the economy. And we have come out of this time and again. And, and I witnessed sort of growth mode sort of coming back and dealing with what really was a situation earlier. So, I don't know what was the 2 weeks of total imports. It must have been a few $1 billion versus about 650 or now running close to $700 billion of FX reserves that this country has. Now, of course, it's got a problem of diversification, whether it wants to be in one currency or multiple currencies, or how diversified its reserves are. So I think this journey is a journey of great introspection and learning, and coming out stronger each time. And yes, the global headwinds, we were only thinking about, the rising interest rates and importing inflation from the developed markets into India. And hence, we're looking at a trajectory of our own interest rates as perhaps one of the bigger risks, and the impact on domestic inflation. We never anticipated that this is such a turn of events is going to happen, and we're now re-looking at this whole aspect. There's no doubt that we have to deal with these risks, the commodity risk, which is there because of not just the hydro, the petroleum and petroleum products, the aspects on so many other commodities, which kind of disrupts the global supply chain, and also our own domestic productions. But I think the important thing is, how do we look at the new opportunities that emerge from here? And that is really the assessment that we should be making now. On top of this, we have to look at what is fundamentally in the long run. What we had identified is the elements relating to ESG, the entire ESG process of sort of providing this, what emerges as players who will come out stronger in the long run. So, you can ask a question as to which sectors do you see as growth sectors from here? Actually, it's funny that any time that I've sort of posed with this question, I sort of think back and say that in all these sectors which we have seen economic cycles also, there are always players who have outshone some of the others. And what you really have to figure out, what quality do they have that they have come out as winners in that? So, even when you have the entire EPC, there are players who have come out of that much stronger when everybody else was sort of having a huge problem. So when the real estate was and infrastructure was in a situation of a difficult situation. So the important element for all of us collectively as business persons or, who are part of the financial markets is to really take a deep dive. These are the kind of moving parts. Where is the possibility of opportunities in our situation that we are seeing, what we have in our site, let's say in our case, India. And in this, which sectors and which companies fundamentally will be able to come out, and what's the quality of the management, the governance, the integrity in the way which they are building these companies. Where is the alacrity in their system to be able to deal with these unknown, I keep saying these unknown unknowns, because that's really what makes the difference. And I genuinely believe that this change that is taking place, it's very unfortunate what happened in COVID, very unfortunate what we are witnessing today in Ukraine and the geopolitical fallout of all of this. But I think the reality is that to run the world, to run the global system, to have people being properly taken care of, economy and businesses have to work, have to take that responsibility to run responsibly from here. And I would say that it is all of us collective responsibility to actually get into that responsible financing or responsible investing that we're supporting good global growth from here. And I see plenty of opportunities with that. This is really every time that we have gone through a crisis, we've come out looking at new opportunities and new possibilities. So I can't control what the inflation is going to be in the United States. I can't control what they are going to do about it. I can only control what is given to us here. And I think we have a lot that we can actually manage in the ecosystem that we have. I am very optimistic about the possibilities for the future.
Great. No, thanks so much, Sunil. I think we agree wholeheartedly with what you've just said. I think we continue to see plenty of opportunities in almost every sector of the economy. We've obviously, as a team, spent a lot of time examining different sectors and subsegments amongst them, and we feel that, as you rightly pointed out, there are plenty of opportunities, especially with great companies and great management teams that can, help out deliver, within their own sectors as well. So just as one final, maybe a takeaway that you may have for both global and domestic investors in our fund and people potentially looking to invest in us, any final takeaways from your side before we wrap up today?
Yeah. So I can sort of say this to all your global and domestic investors who have sort of dealt with you or participated in your funds in Fund 1 and Fund 2, that I have personally sort of been involved with this since the beginning of your Fund 1 or early days of your Fund 1. And the approach that you took, your fund took, of being sector agnostic and looked at anything that made sense from your point of view as a bottom fishing And you and I, or actually the three of us, have spoken on the investment committees at detail, and I have sort of pulled my hair apart in some of the deals that you brought to the table. But looking at the IRRs on those deals, I think it speaks volumes of, I would say, the ability to go through it, identify the risks and the opportunities, and learn from the quality of the management and the promoters that you are backing, and the businesses that they are sort of pursuing with passion and with integrity. I think that has worked out. So number one, in spotting the right opportunity through the way you have actually put this very, very rigorous process, I must say I kind of appreciate that, and I've always sort of appreciated the quality of the work that your team does on assessing the risks and the opportunities, and then coming up with their own value judgment on what is the right proposition that they would like to support, and then of course having this. So I feel that the opportunities that funds like yours, who are sort of looking at mid-sized companies, who are looking at promoters, who are actually demonstrating their ability, that we also have the ability and the passion and the intellect to be, and if we get the right kind of capital support, that we can also become the unicorns, and and I think responsible entities. Unicorn is just a attribute in terms of where they sort of positioning, but as responsible companies for the future. And then of course the value is, comes with it, and people sort of start being responding and providing the right value to kind of acquire that, be part of that growth story. I think that's really the right way to go. I really want to say that I'm not saying this because I've been part of you, but I genuinely believe that the rigor with which you do the sifting of the process that you have, you continue with that, and you will certainly find that most times you will be right, and there will be some that may not work out. That's part of the game. But I think as long as you're on the high side of the probability, I would say that you would be really doing great service to all your global and domestic investors.
Yeah, thank you,
Thank you
Sunil.
so much, Sunil. Really appreciate that, and really appreciate you spending the time with us today in recording this session, and look forward to seeing you in person at the evening drinks.
Thank you for being support to us throughout our journey, Sunil. We're very grateful. If I could get one final thought, I know many investors who are joining would love to get your views on something that's close to your heart, which is the insurance industry. We're seeing a lot of investor interest, particularly on the general insurance side. A very brief sort of remark from you on how you see the opportunity in the insurance space. I think that would be very insightful for everyone listening in.
We've spoken about this opportunity on several occasions earlier, and I'll repeat what I've just had stated to you then, that I see a huge opportunity in the Indian insurance industry for both domestic and global investors. It is an underpenetrated market. There is no doubt about it that as we move along and have moved to a 5 trillion and a $10 trillion economy, one of the most important aspects in that process is providing protection to life and productive assets. There's no substitute to that. And of course, now that we've seen that health has become such an important element as well for people to kind of cover. So that's on the opportunity space. The second, I think there is also an interesting shift that is happening in the how do you access your customers, which are typically called policyholders. I'm sort of much more want to call them my customers. So from moving through indirect model through the intermediary model that has been part and parcel of this business, and which has worked very well, by the way, that has sort of, because you need persistency in terms of people trying to get people to take these policies. That process itself is going through a fantastic transformation of how do you make the selling, and while insurance is really a push product, how do you sort of make some parts of the products into pull products as well, and make it easier and much more cheaper for the policyholders to acquire your products. The third piece is the entire underwriting piece. As you know, on the non-life side, our combined ratios for the industry are unfortunately over 100, and except for one or two players. So the entire non-life industry, I'll deal with non-life and then life and then health, is looking at how do you get better underwriting to make sure that we are not dependent on investment returns only, because as the interest rates start going down, your investment portfolio is not going to produce the yield that would sort of cover your losses on a combined ratio basis. So the quality of underwriting and the reinsurance itself will sort of now be much more, will discern the good players from the ordinary players. So that's another aspect where I think people who've got the right kind of underwriting skills, who sort of using technology far more effectively. And then lastly is, of course, the entire claim system that is there. The claim system has been a very complex claim system. We've sort of always found that people have complained about the delays in claim. So having a more efficient claim system, again, using technology, these are some of the building blocks. And I think in all of these, there is a huge opportunity for technology to play a role, which has not played such a huge role as it has started much earlier in the banking system. So we were still working on legacy systems that had worked very well. So that transformation is sort of certainly in play. On the life side, again, as we have seen that while LIC continues to be a fairly dominant player with 60% market share, but the ability to sort of hold on to that, I hope with the way what LIC is doing now, that it stays there. It is a very, very good player in the Indian market. But I think the opportunity is certainly there for new life players as well, because the growth is enormous. The entire monoline health space is again new. There's so much to be done. I think if you look at really between auto and health, health has started sort of moving at a much more faster clip from here. So both from a monoline players on the health side, and also players who have part and parcel of their on the non-life side, there will be opportunities for that product to grow. India will also look at the entire liability space. Globally, if you see the law of torts is sort of where professional liability is the D&O and the liability side for the non-life. We've not even scratched the surface on that front. As we get more sophisticated markets, financial products and otherwise, governance issues, ESG issues, the whole aspect of liability piece in terms of protection on the liability piece is phenomenal. So you've got me going on this one, Sid, so I don't want to carry on, but
we agree the sky's the limit, and we're obviously very excited to have exposure in the industry and working on.
Yeah, you have to believe in it, that these are possibilities, and we've got to also there are some kind of elements from compliance and the way the legacy practices are. We have to also be honest to kind of deal with those issues, because that allows us to have a free growth from here. So as responsible players, we have to work collaboratively with the regulators and the government, that whatever were the kind of challenges that were there in the past, I think we need to sort of get those out and have the right construct to be able to grow from here seamlessly and efficiently. So I'm very bullish, and I'm glad that the government has, after a gap of about 8-10 months, finally put the chairman of the regulatory authority. So, and he's a great man, and I'm sure he will sort of really put his weight behind. I've sort of know him, and I know that he's a very responsible person. So he will really put his weight behind to at least have the right regulatory construct, because he's got to deal with the LIC IPO. He's got to deal with the 4 state non-life insurers in terms of how they get them back into be able to kind of list them over a period of time. He's got to deal with the entire reinsurance piece on the GIC. We're looking at setting up this entire reinsurers base in the GIFT City and the IFSC that is there. So huge possibilities for all of these kind of opportunities that are there.
Great, thanks, Sunil.
Thank you, Sunil, for your time. Really appreciate it.
Wonderful to have you and your insights.